The S&P 500 ETF VOO is up 11.72% year to date. QQQ is up over 13.5%. A huge reason for this is the craze over AI and microchips and basically technology overall, specifically in companies such as Microsoft, which is up over 15.5% year to date. Amazon is up over 20%, Meta over 37.5%, and Nvidia is up over 134% just in the past 6 months. A very good question was asked by one of you in the comments section. Is there a good time to buy ETFs? Should I wait for the price to drop or just keep investing each month? This is a great question, so let's dive right in. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. So here's the thing. When we keep hearing that markets are surging and that they're at an all-time high, we're definitely conditioned to think that it can't get any higher and that it's gonna crash soon. Because it can't just keep going up, can it? The S&P 500 hit its all-time high this year and keeps going. The Dow just recently hit its all-time high, and that keeps going as well. So how can investors make the most amount of money in the stock market? The simple answer is that if we pick the exact right time and buy at the absolute lowest, then yeah, you're going to profit the most. When COVID struck and the world shut down, there was crazy fear. At that moment, the stock market crashed and the S&P 500 ETF VOO dropped all the way to $210. That was a crazy low, and so if you had put $10,000 in perfectly at that time, today you'd have more than doubled your money because today VOO is at $485. Most people though thought, okay, the market's crashing and we have a global pandemic, so it's only gonna keep getting worse. It can't just start to get better too quickly. And we're just at the beginning of this COVID thing probably, so let's watch it and let's see if it can even drop further. And then at that point, that's when I'm gonna put my money in. Then more shutdowns were announced, so people thought, yeah, let's hold off more until it drops further. Then all the stimulus checks happen and the talks of high inflation has been happening, so people kept holding and kept holding for this drop. Now we're a couple years removed and VOO is at $485. So had you kept waiting for that drop, you would still be waiting. But now we're at a point when it's just been going up, and so people are thinking it has to drop now. But what is a big drop? Technically, a big drop, a very crazy drop, would be something like 20%. Because 20% is considered a stock market crash. So if VOO were to drop 20% from where it is today, that would be about $388. So waiting for this big crash to happen is still buying in at much higher than one could have bought in for most of 2020 and 2021. So yes, buying in at the exact right time is definitely going to make you a lot of money, but holding off and trying to time it so that you can actually figure out when that right time is may actually lose you way more money. We will never know what the actual bottom is until years later, and by that point you will have missed out on a bunch of growth. To better illustrate this point, Personal Finance Club on Instagram put together this super helpful graphic. If one began investing $500 per month in 1984, they would have experienced all of the following: 6 recessions, 2 50+% crashes, 5 bear markets, 12+ US involved wars, 41 Fed rate hikes, global pandemic, the dot-com bubble, impeached presidents, Black Monday, and the Great Financial Crisis. Most, if not all of that, is much worse than anything that we're hearing today as far as bad news. But if they would have just kept investing $500 per month no matter what at all-time highs and through all the scary noise, that person would now have $3,726,455. Time in the market beats timing the market. You'll be able to stick with it and stay the course by doing 3 things. First is to join a group with like-minded investors that have similar goals. My Patreon group is exactly that. We have live Zooms every 2 weeks to answer your questions and to bounce ideas off one another to keep us all investing strong. A group like this really helps you get out of your own head, and many brains together is always more smarter than just one. It's only $20 per month, and the link is down in my description, so sign up today. Number 2 is to make sure and continue to do your own research. Try to figure out what type of risk profile you have and stick within that. Never invest with money that you need in the near future, and make sure to invest in solid ETFs with low fees. The third thing people do to stay successful in investing is to make sure and have a plan, and also to work with a trusted subject matter expert. I do private financial coaching where we can meet and discuss your portfolio and financial plans to make sure you're on the right track. I've met with hundreds of people so far, and it's a huge passion of mine to help where I can. Email me at ProfessorG.invest@gmail.com for more information. Now, if you take a look at this graphic, it shows that $10,000 invested in the stock market S&P 500 over 20 years looks like. If it was invested and never touched, it would be at $64,844. By missing just the 10 best days in the market over 20 years, the return was cut in half to only $29,708. So for those of you that are holding cash out and just waiting because you think that it's gonna drop, if you accidentally miss one of those great days because you're holding out hoping for the absolute bottom, that's gonna really mess with your return. Right now in mid-2024, I'm investing like normal, even through these crazy high prices. Now what I'm not doing is buying into the hype of any individual companies, especially ones like Nvidia. Though I do believe that Nvidia is a very solid company, and I'm probably missing out on some gains by not investing in it, but there's a big reason why I pick ETFs versus individual companies. So make sure you understand the difference. You have to remember that Nvidia is at a $2.8 trillion market cap currently. So if you want to double your money by investing in Nvidia, you have to expect Nvidia to hit almost a $6 trillion market cap. Our biggest companies ever in history just barely hit the $3 trillion cap. Individual companies have much more of a ceiling as far as how far they can grow, because there's only so much market share that one company can take. But solid index funds and ETFs are built in a way where they can continually take market share from different industries since they're so broad. This is exactly what the S&P 500 has done time and time again for over 70 years since inception. To check out my favorite 3 ETF portfolio that includes only ETFs and index funds that are in this type of category, check out this video here, or watch this video to keep going strong in your investing journey.